The fallout has started. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, alarming signs point to trouble for the economy as plunging inflation signals brewing labor turmoil. Plus, we have a sponsor for today's show. You might remember our friends Edge TI, leaders in the AI space, now trading on the OTC under the symbol UNFYF. They have a big announcement, not to mention their stock's been heading higher ever since we featured it on our show. Stay tuned to the end of the show for more information. Now let's over to the Wall Street Journal, where we picked today's story up with a headline: CPI report shows inflation has been cut in half from last year's peak. And this just isn't a story about the Fed, who is now meeting today. Of course, we'll hear from Fed Chair Jerome Powell tomorrow at the press conference on what they're going to do about the federal funds rate. The bigger issue here is any time in history we see big moves higher in inflation, they're followed by one ominous signal, and it's called a recession. The so-called core consumer prices, which excludes volatile food and energy, climbed 5.3% in May from a year earlier, down from 5.5% in April. Economists see core prices as a better predictor of future inflation, and yet they remain elevated due to a surge in housing rental prices that continues to show up in the inflation figures. Now, of course, we note that this housing rental inflation signal is a lagging indicator. It's highly lagging. So for now, what we're seeing is an elevated core inflation, but at some point that's going to roll over and head down. We'll dig deeper in that, but let's just show you what the experts are talking about here. Is we have the headline CPI in blue. This includes food and energy, both of which highly volatile, against the red, which is a core CPI, excluding both of those. And we can note there are periods in the past where you see the blue line just sharply cut through that core CPI, and eventually, with a lag, the core rolls over and heads down. You see that coming out of the dot-com bubble. You see it in the middle of the global financial crisis. You're seeing it now. So all signs, right now tell us that even though the core may stay elevated, and it can stay elevated, it certainly is going to roll over and head lower. It's going to follow that headline CPI down. As overall consumer prices increased a seasonally adjusted 0.1% in May from the prior month, down from April's 0.4% increase. Again, validating we're seeing inflation cool off. Core consumer prices still remain hot at 0.4% in May from the prior month, the same pace as April and March. Now that's going to weigh on policymakers' decision. Of course, we'll hear again more from the Fed tomorrow, but the question we'll ask is, are they going to pause or not? The answer, I think, is if they don't pause, they're going to hike and then pause the next meeting, or they're going to hike, or they're going to pause this meeting and talk about hiking the next. And I'll show you why. Let's dig into this headline report here. Because what we can see is it's dominated in a deflationary sense, and we've been talking about how this was happening due to the year-over-year comparables in gasoline prices and crude oil. We're going to have a negative impact on the consumer price index. Here you can see it, these big, giant minus numbers, but let's look a little higher. What is still keeping the headline CPI up? Well, of course, we know that it's still food is running at 6.7%. That's a bit hot. We see electricity still up there around 5.9. But now let's get into the core, because the core is what all these experts are looking at, because it's really simple. If you don't get the data you want on one report, you just shift over and say, well, we know a headline's coming down, but really we care about the core. So that's what they're going to shift. You're going to hear a lot more of that. But looking at the report, what do we note here? New vehicle inflation has now jumped up 4.7% year over year, remains rather hot, although we're seeing deflation start to pick up in April and May. How about we see apparel? That's remaining rather strong at 3.5% year over year. We can see that medical care is still running relatively hot, but this is a big one. Shelter services, less energy. There's your shelter component, 8%. Transportation, 10.2%, and that 8%, that doesn't seem, it is a kind of a big number in the report, but its weighting in the report is very large. That's the issue here. As soon as that rolls over, and it does eventually with a lag, that we will see that core CPI come down. In the meantime, as we showed you you on yesterday's show, the real key here is gasoline prices, because it backfeeds. You talk about how critical energy is in our economy and what it means to inflation. It backfeeds into everything and is a leading indicator of where inflation is going. So here we can see U.S. regular all formations gas price on a year-over-year rate of change, leading that headline CPI number down. If we indeed see the headline CPI come down all the way down to here, what you're talking about is a sub 2% headline CPI number. I know many of you don't believe that that could possibly happen. We know policymakers don't believe it either, but if gas prices remain true to what it is as a leading indicator, it won't be long before we see that headline number come crumbling down. The Fed has aggressively raised rates from low levels starting last year to slow economic growth and tame inflation, as Fed officials in May raised the benchmark rate to the current range between 5 and 5.25, the highest level in 16 years. And Feds are looking for signs that inflation is moving closer to its target. Despite its effort, inflation remains stubbornly high. Of course, maybe the real question is maybe the federal funds rate has no impact on inflation at all. Of course, the Fed doesn't realize that because they just showed you the chart that matters with inflation is energy. And when we look at this next chart of the federal funds rate, what we can note here is it almost has no meaningful impact, because the Fed is often cutting rates long before inflation rolls over and heads down. This is kind of the first time in modern Federal Reserve history that we're seeing the Fed aggressively keep rates higher and almost waiting for inflation to come down. Of course, if you need something to validate something else, well, there's one way to do it, is just raise the federal funds rate until inflation keeps coming down, so you can say, look, we caused that to happen. Throughout history, though, usually the Fed is cutting well before inflation comes down, because it's the energy sector that really matters here in terms of driving inflation. But if we look at where the problems are in the economy, we keep talking about it's a wage issue. Workers are not keeping up with inflation. Here's the latest data, this chart from Zero Hedge. We see U.S. real meaning inflation adjusted average weekly earnings going back between 1982 and 84, looking at a year-over-year rate of change. And here we can see all this red part here? That means wages, inflation adjusted wages, are not keeping up with inflation. They are negative. And all that tells us, in a big way, is that consumers can't afford higher prices. So they can take on more debt, which we've talked about in the last couple of shows that they're doing, but in the end, it leads to reduced consumption. That's why we're seeing inflation come down, is with demand, as we're about to show you in the next report, is coming down in a remarkable way. As U.S. small business sentiment remains subdued on sour outlook. Now, this is something we shouldn't be hearing about, because small businesses should be relatively optimistic. If we're experiencing a no landing or a soft landing, then businesses should tell us, hey, you know what, we're kind of in a soft patch right now, but we have a lot of reason to believe that demand is coming. This headline gives us no indication that's happening. In fact, it tells us what we kind of know is coming, is things are going to get worse, and that's kind of where we started the show at. So let's continue on. As U.S. small business sentiment in May held close to the lowest level in a decade on dimmer views about the outlook for sales, the economy, and credit conditions. So here you're hearing from small business saying, look, we don't see sales getting better, we don't see the economy getting better, and we don't see credit conditions easing where our customers could come in and finance things, because that's really key. They need looser credit conditions, not only for their customers, but for themselves. So again, the outlook here does not suggest things are getting better. The National Federation of Independent Business Optimism Index ticked up to 89.4 from April's reading of 89. All that was the weakest since January 2013. And a measure of sales expectations fell for a third month to the lowest since July, as sentiment about future business conditions also deteriorated, and a gauge of expected credit conditions slid to the lowest level since the end of 2012. And while many larger companies have wherewithal to navigate higher rates simply because they have higher margins and easier access to credit, stubborn inflation and persistent labor challenges, many small businesses are feeling the squeeze, and that we know that these small businesses are not able to absorb higher prices like their big businesses. We know they have labor issues here, and this is only going to get worse. Here you can see the consumer price index for all consumers, this in blue, on a year-over-year rate of change against the University of Michigan consumer sentiment. So we're going to use that as a proxy for business sentiment. Now, why are we doing that? Because when consumers are pessimistic, small businesses become pessimistic. And in turn, what do you think happens with demand? Well, that's why you're seeing sales fall here. And this gives us a really good indication of just how much of an impact a lack of demand from consumers can have on inflation. Here you see in red the University of Michigan consumer sentiment heading at low levels. And look, going back to the 80s, what happened? Inflation came crumbling down. Here you can see sentiment in the 90s drop. Inflation followed down with a lag. Here you can see it going into the dot-com bubble. We see sentiment coming down. Inflation came down. Here you see the global financial crisis. And here you see sentiment staying down. Now, because remember, back not too long ago, everyone thought the sentiment hit a low. We kind of suggested on the show that no, maybe that's not quite the case here. The sentiment is going to stay down because consumers just don't have the money to continue to spend. And now we're going to see kind of what is actually the next bomb to drop on the economy is higher unemployment claims. Last week, we saw 261,000 initial claims. On Thursday, we'll get the latest data from last week's claims. And of course, if this continues to head higher, it's game over for the Fed. It's game over for inflation. Here you can see that 4-week moving average of initial claims moving higher brings, of course, inflation way down each and every time. That's why, my friends, we know the labor market here is critical. It's not just a function of wages. It's a function when people lose their job and they go on unemployment, they make less money. You make less money in a period of time when you have a high debt load and high interest rates. So you not only have a lot of debt, but your payments on that debt are high. What does that mean for your consumption, particularly as rents have gone up, energy prices have gone up, and food prices have gone up? It means your discretionary spending is getting wiped out. That's why you're hearing these small businesses saying, look, we're not that optimistic. The challenge they're facing, and we're seeing this in the factory sector as well, they're being forced to hold on to labor. The only question is for how much longer can they hold out before they have to issue a whole bunch of pink slips. Overall, small business owners are clearly in a recession mood, expressing great concern for future business conditions as supply chain disruptions and labor shortages will continue to limit the ability of small firms to meet the demand for their products and services, which is in decline. And while fewer owners said they raised prices in the prior 3 months, the greater share plans to boost them. A larger also reported boosting worker compensation in an attempt to hang on to those that they've got. The problem is the productivity of these workers is rapidly declining, and that is an ominous sign that we are actually seeing a huge decline in consumption and demand, and that every time we see this, it tells us there's a recession. As everyone is getting less productive, and that's a big problem for the economy. As it stands now, the major disconnect is this: as companies keep hiring into a hot market, they're not getting much out of their workers overall, possibly because they don't have enough work for them, and that's fueling a stealth economic slowdown. The recent decline in productivity can be seen in the chart below, which we're not going to look at because we have our own chart. And note that the downward inflection point came at the end of 2021. Here we can see, looking at labor productivity has fallen for 5 straight quarters, the longest such streak on record. Here's what I really want you to see is the non-farm business sector labor productivity in blue. Now, when this blue line is below the horizontal black line, it means labor productivity is doing bad. It means that percentage year-over-year rate of change is negative. They're less productive, and we're going to overlay that with, again, the consumer price index. And what I want you to see here, going back even to the 70s, labor productivity went negative. What happened? Inflation followed it lower. Here you see it again in the mid-70s. Inflation came down. How about the 80s and then the kind of the early 80s? Inflation down, productivity negative. You see it over and over, these major shifts, and now we're seeing it happen again. What it's telling us is why this is happening during a recession is simply because it's a demand issue. Employers have bought into the narrative that they've trained all these people. They now finally figured out they don't want to lose them and have to retrain them a second time, so they don't want to let them go. They need demand to come back. And what do we just hear in the NFIB report? That demand isn't coming back. They don't believe it. But one thing who is making a big move, and that's our friends over at Edge TI on the OTC, symbol UNFYF. They've got a big announcement in the AI space today. Let's take a look at what they've got. As Edge TI announces a fast path to safe and successful AI. A few AI initiatives match the velocity of OpenAI's ChatGPT, which amassed huge followings in mere weeks. Unchecked, they say, ChatGPT sped past policies on intellectual at the highest levels of government and corporations, according to CEO Jim Barrett. Now, this is a big concern, and of course, if you're looking to implement technology in your company, particularly in the AI space, using products like ChatGPT, there's a reason why you need to be talking to Edge TI. There's a reason why I think their stock's going to head a whole lot higher in the near future. I'm going to show you that in a moment, but let's take a little further look at what Edge is up to here. As to deploy AI capabilities safely and responsibly, organizations need to effectively implement the following three concepts native to Edge Core. You need to put on some guardrails and establish and maintain some boundaries, have transparency to empower users to visualize what feeds the AI, and orchestration to enable users and leaders to compose and sequence the next steps and actions for smooth, tightly coupled operations. All three things you can get with Edge TI. And since 2021, we've tested and developed capabilities across a wide range of AIs, remarked Scott Leslie, the CTO at Edge. In early 2023, we used our native capabilities to compose conversational AIs into operations using OpenAI's ChatGPT and ServiceNow, which have added conversational capabilities. We'll get this with zero modification to legacy systems. You want to bring in, of course, this kind of technology, this AI technology to your company. All you got to do is give Edge TI a call. There's a reason why their stock just recently started trading. You know, we announced it on the show. It's been heading up since then. I want to show you why I'm going to see that head a little higher, because Edge, they've got results-driven AI adoption programs as they've developed methods proven to operationalize AI, and companies can accelerate and improve the success of their AI strategy by leveraging one of their adoption programs. And now let's take a look at what's going on. Now remember, they haven't been trading very long, and we kind of announced this on the channel. You remember when this came out on the OTC, and the stock has gone nothing but up there. But here's the key thing. We can forget a lot of the technicals because it just doesn't have enough trading history. But look at this kind of red bar here. This is the volume profile line since they have started trading. And what we're seeing is support right here in this band going down to around 98 cents. If this holds, what you can kind of look to expect to see, especially on one of these kind of newer issue stocks that's getting some attention, and Edge TI is making waves in this space. If they get enough attention and the stock starts to move and breaks through that zone of sellers, well, you can only imagine it's got a whole lot more to move higher. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.